Today I'm in a very comfortable position because I think this one's going to be a long one. So get yourself a cuppa, get yourself strapped in, and let's talk about dividends. Welcome back everyone, my name's Paul. If you've never seen me before, I recently started investing and I've been documenting it on YouTube. At first I made a lot of mistakes and I'm still making them. So I make these videos just so everyone can see and try not to make the same mistakes. When I decided to take investing more seriously, I picked the dividend investment strategy. So today I want to go into that a little bit more. I feel like this is going to be a little bit of a longer one, so I've time-stamped everything, and if you feel like you want to skip ahead to different parts, or come back a little bit later because you've got bored of my voice, hopefully these timestamps should make life a little bit easier. Today I've got to catch up on a little bit of news from the week. The British economy released its GDP figures and they weren't good. That's caused a big sell-off. We'll look into why. And an interesting one for me is that Tyson Foods has cut its beef prices in America. I want to delve a little bit deeper into why they're doing that because it's really about the economy and jobs rather than Tyson Foods shutting all its factories. I'll go into a little bit about dividends and why I don't see dividend cuts as such a big problem. And then a lot of people have been asking me how I evaluate dividend companies, so I'm going to shove that in there at the end. So I've got a long couple of hours to go and the American markets are probably opening up in 15 minutes. So we'll see what happens when they open. It sounds like it's not going to be very good today. So let's get on with it. First I've got to talk about Vector IQ and Nikola because everyone is talking about it. Like me, you've probably never heard of Nikola until a couple of days ago. But news came out pretty quick when they decided to float on the market as a company called Vector IQ. They're merging up and they're going to change their name to Nikola eventually. I think it's June. And that has sent that stock into a frenzy. I didn't know a lot about Nikola until a couple of days ago, but it's a healthy startup company with a 3 billion valuation. It's got some cool trucks that look like stormtroopers, and it wins first prize for the least imaginative name in the electric vehicle industry. I did put 70 quid in as a pure gamble and a pure speculation because I knew everyone was going to go for it and the price was going to rise just based on that. We didn't need to know if the company was actually any good or not. I don't know how far I am from selling it, to be honest, because I don't know enough about the company. It's worth making a couple of quid on it, but can I really keep it? I think my plan is to wait around till the merger, let all the news outlets have their field day, and then probably sell off and just count that as a win. More importantly, the FTSE 100 is down 5% in 2 days. That doesn't feel good. News outlets seem to be lining this up as a coronavirus fear thing because not everyone's going to take the new lockdown measures seriously. But there's been no rise in cases or anything like that, so there's no reason to think that's the reason. It's more likely that the FTSE's down due to the release of low levels of GDP. It doesn't feel good for a long-term investor like me because we're going back in the red again and there's no access to my money. It means I'm definitely in it for the long term because now I have no real way out. But how far do we think this drop's going to go? Is it just a correction because everything's a bit overvalued? Or is this just another big setup for a big crash in Q2? There's no doubt right now that people are out there selling. And for me, even if I wanted to, there's not much I can sell anyway. So I'm pretty much staying where I am. I'm reevaluating a couple of companies just to make sure that they're okay for the future. But overall, I'm buy and hold. Finally, I just want to talk about this news about Tyson Foods. Tyson Foods is a company that I invest in. It's one of my favorite companies that I own. It's one of the biggest meat companies in America. And if you've seen my previous video, I'm really into it because it's into lab grown meats. But until all that pays off, they've still got to make money packing and delivering meat to America. They've had a bit of a rough time recently, cutting 25% of their meat production due to coronavirus. And today they've cut their beef prices by 30%. They're saying that this is because they want to keep beef on the tables of America. And to me that's quite scary because that means they must have seen something in their sales that suggests they're not getting as much beef out there. They're thinking that it's too expensive, and is that because there's no jobs? Is that because people are on a lower income? Is it because they feel so worried about the future that they're actually stopping buying beef in America? For me, that's quite a big red flag because in America, beef is quite a staple. And if people are refusing to buy it because it's too expensive or because they don't have the money to pay for it, their economy could be in worse shape than we think. I can't possibly guess what that's going to do to Tyson's share price today. But for me, I feel like it's a positive move. It's going to do them great press, but it's also going to get them more sales, which is what they need right now. Okay, American markets have opened up. Let's see what it's done to me. Ooh. Painful. So with all this problem about GDP and how bad these companies are doing, we've got to talk about dividends. Dividends are payments made by companies when they've got a little bit of excess money that they pay back to shareholders for holding shares. At the end of a financial year, a solid and well-developed company should have lots of profit left over. With this profit, they can do three things. They can choose to reinvest it into their company, they can choose to keep some for a little bit of resilience, or they can pay it back to their shareholders as dividends. Ideally, a solid company with good revenue growth should be able to do all three. This is different to companies that are still growing, who are more likely to reinvest into their company or more likely to give themselves a little bit of emergency money. But if you take a big company like Diageo, who sell alcohol, at the end of the year, when they've made loads of profit, in exchange for me owning one of their shares, they'll pay me a dividend at the end of the year. The money I'll get from one share of Diageo isn't even going to get me close to buying one bottle of their whiskey, but if you own more of those shares, they're going to give you a little bit more money. The idea of compounding dividends is that I could keep adding money to Diageo, and the more money that I put in, the more dividends I get back, and so on, until the amounts of dividends that I'm getting back are paying me a nice wedge. The only problem with this in a recession is that companies like Diageo are going to cut their dividend. Diageo is heavily based on pubs and clubs being open, and right now they're not, which is going to cause a big problem. And while a company like Diageo will still have some profit at the end of the year, they're more likely to pile it back into the emergency fund. They've got to keep the business afloat, and when this whole thing blows over and it's like it never happened, because Diageo's got that emergency fund, it's more likely to pay dividends back quicker. It's why I'm not scared of still buying companies that have cut their dividends. If you take Shell for example, it's suffering a lot today, mainly because it cut its dividend. But Shell will have every intention of increasing that dividend next year, even if it's just slightly. What happens when a company like Shell cuts its dividend? The price drops dramatically, which is where I want to be getting in. If I can buy Shell at a cheaper price right now, and either next year or the year after, it decides to announce that its dividend is increasing again, the share price will go up and I'll start to profit. And this is a similar story across loads of companies. In 2008, when the market crashed, FTSE 100 companies cut their dividends all the way through 2008 and 2009. In late 2010 and 2011, dividends started coming back, and they went on really quickly to record highs. And investors who got in on dividend stocks in 2009 and 2010 saw a double whammy in their growth. First of all, in 2009, the prices were rock bottom, so people were getting them on a massive discount. When companies started reinstating their dividends, people started buying again, and the share price went up. At the same time as the share price went up, dividends also grew as well. So not only did the investors benefit from the growth, they also benefited from the dividend growth as well. There's actually an argument out there that dividends are pretty much irrelevant to the growth of a company's share price. That's kind of true. To gain a dividend from a company, you have to have bought into the share price before its ex-dividend date. That's a cutoff point where you need to have owned the shares in order to gain the dividend. The day after the ex-dividend date, a company's share price will fall exactly the amount of the dividend. This is basically just to stop people from buying in before the dividend date and then selling straight after the date. So it's very clear that actually paying out dividends is detrimental to a company's share price. Until you remember that the market is not truly mathematical. People like income from dividends, and they also like to redistribute those dividends to the rest of their portfolio. So dividends don't act as just one single thing to prop up the same company. People are often using dividend payments to support other parts of their portfolio. It's also worth noting that some of the best companies with the best financials are the ones that pay dividends, and that isn't a coincidence. So for the final part of this video, I just want to show how I go through Trading 212 to find some good solid dividend investment companies. You guys have been asking for it. It's pretty boring, but hopefully it's going to be useful for you guys to just find your way around the app. As usual, always come to your own conclusions, pick your own things that you care about, because I am not often right. So when I'm looking for a company to invest in, I look for companies that I know a little bit about. If there's a company that I really don't know anything about, I'm not going to go near it because I've got a lot of learning to do. But at least 90% of the companies in my portfolio I have had personal experience with in one way or the other. I've got to say, companies in the FTSE 100 are not as easy to evaluate as ones in America. There just aren't as many good solid companies in the UK as there are in the US. Diageo is a fairly easy one to do. It's having a tough time at the moment because all the pubs and clubs are closed, so they aren't selling as much alcohol as they normally would. And I can safely say that in the past I've been in touch with quite a few of Diageo's products. One of the first things I look at is a company's PE ratio. Diageo's PE ratio is quite high, which suggests people are really into it. Whereas if I had a company with a PE ratio of say 1 or 2, that would probably be a sign that I'd need to be a bit wary of it. The second thing I look at is the dividend yield. Even though I'm well into the dividend investment strategy, the dividend yield is not the most important thing to me. I have to have a look at it to see if it's actually got a dividend coming in. But the actual dividend yield varies based on all sorts of things. So really, I am looking at a company that's got a dividend of around 2, 3, 4%. But again, it's not the most important thing. But I would say that I get very wary of companies with, say, a big dividend yield, like 10, 12%, something like that. Because that suggests that either their share price is really low for some reason, or that they're paying a significantly higher dividend than what their share price suggests they should be. But I'm not married to this dividend yield percentage. So the next thing I look at is the payout ratio, or the dividend cover. You can go into all ratios and it gives you a ridiculous amount of stats. Don't be scared of this. It can be quite daunting at first, but most of this information that's given out isn't really that useful to the average retail investor. What I want to do is I want to go to per share data, and then I want to look at EPS normalized, which is sitting at 126. That's Diageo's earnings per share in the last year. Then I want to scroll down to dividends, and I want to see the average dividend per share, which is sitting at 69. That tells me that the dividend payout is considerably lower than the EPS. It means that they're earning more money per share than they're paying out per share. A much similar way of seeing this is if you scroll along to financial strength. You can then scroll down to payout ratio, where you can see that Diageo has a payout ratio of about 51%. Payout ratio is just a measure of the dividend per share versus the earnings per share. If the payout ratio is over 100, it means that a company is paying more money in dividends than it's actually earning. And that means the dividend is usually being paid out by debt. Diageo sits nicely at 51%. It's a little bit high, but well within the range that's needed. Next up, I'll go along to the income statement. And what I want to look at is the total revenue of the company. Usually, I would like to look at least 5 years of revenue. And Trading 212 usually only has 3 years. But 3 years does give you a good starting picture. What we want to look at is that total revenue at the top. And we want to scroll along from 2017 to 2018 and 2019. And what we want to see is that total revenue going up in number as the years go on. That shows that Diageo is increasing its revenues every year, which means it's growing. As a bonus, you might want to scroll down to net income. Diageo has a net income of 266 in 2017, 302 in 2018, and 316 in 2019. The net income is the actual profits Diageo is making, and it's making more and more year on year. What you want to see is the purple revenue bars in this graph going up nicely every year. And if possible, you also want to see the net income going up with it. What you don't really want to see is the net income and the revenues falling apart. And also, I definitely don't want to see them decreasing together year on year. So that's all the data I'd be looking to gather up on a company from Trading 212, and it only takes me about 5 minutes. The hardest part comes next when you actually have to leave the app. The next important thing for me is the dividend safety. During the coronavirus, Diageo has not got a very good dividend safety score. But over the years, if I check on Dividend Max, Diageo has got quite a nice dividend history, and I can take a reasonable chance that even though it might cut its dividend this year, it will try and bring its dividend back as soon as possible. You've also got to develop your own opinion on how relevant a company is going to be in the future. Diageo is quite a good example. It's got a very full-bodied portfolio of alcohol products that it delivers all around the world. To me, it feels like it's going to be around for a long time, and it's got a really big piece of the market. And finally, you want to check on any negative news. Diageo is actually fairly squeaky clean. It's an alcohol company, so that comes with its own inherent risks. But really, the only bad news that I could find was that a Scottish village was pretty upset that they moved their whiskey factory one year. All these things tell me that Diageo is quite a good investment for the long term. And that's why I have it in my portfolio. Maybe I should take you quickly through one that maybe I would avoid and why I would avoid it. It's much easier to take you through a company that I don't think is very good, so let's have a look at Imperial Brands. Imperial Brands, straight off the bat, does not look good according to its share price. We should never take that for granted because we know there's some serious companies out there right now which have taken a beating. First, to take a look at the PE ratio at 1030. 1030 isn't that bad, but it's below the 14, which suggests that people are losing a little bit of faith in it. First big red flag is that dividend yield of 12%. Fair enough, it's lost a lot of share price recently, but 12% is pretty high, and that's sounding dodgy. If I go into the ratios, I look at the per share data. It's £1.63 on its EPS and £2.7 on its dividend. That's going to tell me that its payout ratio is pretty high. Its payout ratio is 194%, which means its dividend payouts are double what it's actually earning. This is not sustainable. A company cannot keep paying out dividends which are worth more than it actually earns. If we scroll to its income statement, its total revenues are fluctuating. But it's not actually that bad. There are plenty of companies out there that have a little blip in the middle. Ideally, you would want to see a company going up, and really, you wouldn't want to see a company going down. But its net income each year is having a mare. It's very slowly decreasing in total profits year on year. That is not a good sign to me at all, especially when its payout ratio is so ridiculously high. And do I think that Imperial Brands is future relevant? Not really. It's a tobacco company that isn't diversifying. Other tobacco companies are going into different things. Imperial Brands is pretty much sitting where it's at, and it's just trying to push cigarettes onto developing countries, which earns it a lot of negative press. So Imperial Brands is one company that I would avoid. And finally, I'd like to take you through a bit of a tougher one, which is AstraZeneca. AstraZeneca is doing ridiculously well at the moment. I think right now that because Shell cut its dividend, AstraZeneca is now the top of the FTSE 100. I personally have had a lot of experience with AstraZeneca. I was actually one of their guinea pigs while I was at uni. I know I've always been happy to invest in AstraZeneca. I just got to them a little bit late when my ISA started, so I haven't been able to put as much in as I wanted to. If we scroll down, we've got a massive PE ratio of 122. That's way too high for me. It tells me there's a lot of speculation about AstraZeneca right now, and it might not necessarily be based on earnings. And if we have a look at its dividend yield, it's sitting right nicely where I'd like it. We pop into the per share data and we've got an EPS of 73 pence. We scroll down and we've got a dividend of £2.37. This is a bit of a warning flag for me, as we've discussed, and its payout ratio right now is 269%. It does have some fluctuating revenues, and its net income has gradually been decreasing over the past 3 years. AstraZeneca has a great dividend history, but its dividend right now is not sustainable and it cannot be safe. So for me right now, its fundamentals are pretty poor and pretty unsustainable. But if we look at how relevant AstraZeneca is in the future, it's actually pretty good. AstraZeneca has some top drugs out there. The statins are its biggest one, which millions of people over 50 are using. And it's also recently had FDA approval on lots of its drugs. The main reason for its share price spiking so hard is it's actually working with Oxford University right now, and it reckons it'll have a vaccine out by about September. This is all really positive news, but it's total speculation. And the competition that it's got from GSK and Moderna and Novavax, it's really got to be something special. Not to mention, Pfizer keeps making serious hostile takeover attempts that has really been knocking AstraZeneca about. So it's a really hard one to evaluate, and it's actually a bit of a gamble right now. Because if it's not the first one to get to the vaccine, share price is probably going to tumble when it doesn't deliver the goods. And with the FTSE 100 taking a beating right now, I think with its fundamentals, I kind of want to sell it. I kind of want to use the profits I've made from AstraZeneca and redistribute it into the rest of my portfolio. So I'm doing it. I'm clicking sell, review order, send sell order. And that's it. Today I've sold my shares in AstraZeneca. Bloody hell, that was a long one today. I hope some of that's useful. Thank you very much for watching today. If you made it through all that, well done. Let me know if you guys prefer the short videos or the long videos, because I've even bored myself recording all that. If you've enjoyed this video, please feel free to give it a like and subscribe. And if you're looking to sign up to Trading 212, there is a link in the description below. If you sign up through that link and deposit £1, you get a free share and one of my subscribers gets a free share. And if you're looking for more help, please join the Discord group. There's loads of people in there. They're really friendly. There's loads of people talking about stocks. It's really cool. And I should see you back next week with another video. Thank you very much for watching. Please like, subscribe, and invest.